Edward Brown, host of The Best of Investing, here to remind you to tune in this week on Saturday at 8 p.m. Our guest is going to be Troy Eckerd. You're not going to want to miss this show. That's The Best of Investing. Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. That certificate's not sponsored by the radio station, but by Tambella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is miscellaneous trivia. Before I introduce my guest, I do want to make a mention here for Pacific Private Money's new fund called Arrival Fund, and it's paying, get this, 10%. Minimum investment is $100,000. They're backed by first deeds of trust that are being originated, and then they're being sold in the open market. Actually, I shouldn't say open market because they already have a buyer lined up, and they just put it on the conveyor belt, and every 2 weeks they sell these loans. So it's a fairly liquid fund from that time frame standpoint. But if you wanted to redeem your money, we do ask, or they ask, for a year hold period. So it's a 1-year hold, and then after that you can ask for your money back. Check them out at pacificprivatemoney.com for more details. Let them know that you heard about their fund on the Best of Investing radio show. You do need to be an accredited investor, and when you check them out, they'll give you all that information. All right, today's special guest is Matt Spagnolo from Colony Hills Capital. Matt, welcome to the Best of Investing.
Edward, appreciate you having me. Glad to be here. Happy New Year.
Hey, Happy New Year. That's right. It's our first show of 2025. I'm going to read a little bio here. Matt has a background in business and economics, initial background in residential and commercial brokerage, now fund co-manager at Colony Hills Capital, raising capital for the co-GP fund and direct deal private placements on multifamily real estate. Equity raises of $20 to $50 million per fund / deal. All right. So first of all, Matt, what's the current state of the market?
Yeah, great question, Edward. We're super excited about where we are in the market cycle as a buyer. I think that it's a great opportunity for not only mismanaged deals or deals that might have some issues or might need some liquidity. We've got cash and we've got investors lined up ready to acquire properties. This year we got a closing lined up for February. So we're ready to hit the ground running, and super excited about the opportunity and the cost basis and some of the discounts that we're getting on some of these properties.
And is it primarily multifamily? That's your specialty?
All multifamily, value add, class A- to B properties. And then there's usually some sort of mismanaged story with the seller or something that went wrong where we're going to come in and get a good discount on day one.
And where do you generally buy your real estate?
Yeah, great question. Historically, Colony has bought in the Southeast, Sun Belt, and Texas. And recently, we've actually seen some opportunity, and we've been more of a first mover back into some of these affluent markets in the Northeast, outside of New York City. So we're not in Manhattan by any means, but the affluent areas of New Jersey, Massachusetts, and Connecticut, we see are very strong markets that are seeing year-over-year rent growth and are in supply-constrained markets where the barrier to entry for new units is pretty tough versus all of the units that are coming on in the Southeast and in Texas and Florida. We see some opportunity in the Northeast.
Okay, we're going to cut to a break here in just a minute. When we come back, tell us a little bit more about the market from the standpoint that I know things were with residential real estate. Multifamily was a little touch and go there for about the last year, if I'm not mistaken. I'd like to find out from you, like, what the what has changed, besides just let's say the election. All right, we're going to go to our first commercial trivia question here, and again, as a reminder to Matt, if you know the answer, don't say anything quite yet. All right, what was absent from the first telephone book? That's our trivia question. What was absent from the first telephone book that was published? All right. Call 888-912-1190. First caller with the correct answer wins that tanning certificate, which, by the way, is worth about $100. So that's a nice little gift. I do want to make a mention here also for the Lakeshore Lodge. You know, it's ski season now. They've got a couple hundred feet worth of beachfront property. Check them out at the Lakeshore Lodge. I've heard from a number of listeners that that's a beautiful place to visit. LakeshoreLodge.com. All right, stay with us. You're listening to The Best of Investing. Don't touch that dial. We're going to be right back. Welcome back to The Best of Investing. I'm Edward Brown, along with my special guest, Matt Spagnolo, excuse me. First trivia question. What was absent from the first telephone book? What do you think, Matt?
Oof, good question. I'm gonna guess an emergency contact or like 911.
No, are you ready for this? What was absent from the first telephone book? Telephone numbers.
Oh gosh.
Users would simply tell the operator the name of the person they wanted to reach, making phone numbers unnecessary at the time. The directory only listed names and addresses. Is that funny?
Wow.
Let's see. I also want to make a mention here for Mountain Mike's Pizza in San Rafael. Pizza the way it ought to be. It's a great place to go get pizza in San Rafael, especially for those football games that are be coming up with the playoffs and then the Super Bowl. So check them out. Mountain Mike's Pizza, sanrafael.com. All right. So Matt, now in the last year, there were some changes or in the marketplace for residential, for multifamily. What changed?
Well, I think rates have played the biggest role in regards to acquisition. We saw liquidity and transaction volume way down over the past kind of 6 to 18 months or so. Talking with our acquisitions team, again, I'm more on the fund management side and the capital market side, but they're telling us that the spreads between what sellers want for their properties and what buyers are willing to pay is just too wide for those transactions to occur. I think part of that is the sellers want the prices that they could have got in 2020 when rates were at 3% and 4%. And buyers are just willing to pay what the properties are worth right now. So I think that we're, as a buyer, we're not moving off of our purchase price and what we're willing to pay, and then waiting for the sellers that need liquidity or their funds rolling up, and then they finally come down to where we're willing to buy. So I think that's part of it. But I think for us, a lot of our properties have been strong on occupancy because the residential market has also been tough. If interest rates are still high, then their other alternatives to go buy a house. And if their mortgages are still extremely high, they're feeling more compelled to stay at our apartment complexes and pay $300, $400, $500 less in rent versus what their alternative would be.
Gotcha. And do you buy all cash or do you use some leverage?
We use leverage. That's another adjustment that we've had to make internally. Recently, we've been finding more assumable debt deals. So the deal closing in February, we're assuming 4.8% interest with 10 years of term left. So we're finding those unique opportunities where we can get better debt than we would currently, but we usually will go with government, Fannie, Freddie debt on all of our acquisitions, fixed rate.
And generally, what percentage leverage are you?
We're pretty low leverage. I would say anywhere between 55 to 65% leverage.
Fair enough. And how long has Colony been in business?
We've been in business for over 15 years. Colony has seen multiple market cycles, and our CEO and founder Glenn Hansen and his partner David Kaufman, they've seen multiple market cycles, but also have business experience outside of just real estate. So we've been around for quite a while, and we've done a little over 13,000 units, 1.2 billion in total capitalization. So we've been around the block for a little while.
So with the leverage, generally you're going to shelter the income with the depreciation. So I got to think that very little income that gets paid out to the clients would be taxed currently. Maybe part of it. Through our co-GP vehicle, we pass depreciation off to our investors as well. So a lot of that depreciation is able to offset the income that we have.
Historically, we had been lower on the yield and cash on cash, but we found this unique deal that has a couple of unique parts. And the deal that's closing in February actually has an average yield of just shy of 10% over the 5 years. So it's
Okay.
a very high cash flow deal for us and for a value add deal. I think part of the reason we've had so much interest coming in from our investors, but you do get that depreciation. And sometimes if you choose to take it all in year one, there'll be leftover depreciation that you can pass off to some of your other passive NK1 income.
And generally, how long a term are you looking to hold property?
Yeah, good question. I'd say our shortest hold has been 2 years and 3 months, and the longest hold was a little over 5 years. So anywhere
Okay.
between that 3 to 5 year time period is where we would ideally like to hold the property. It allows us to stabilize the property by the end of year 3, and then start potentially taking offers and provide liquidity to our investors to then roll into the next opportunity. So because our capital is sitting right alongside our investors, we want to make sure that we have the most efficient use of their capital as well as ours. But we believe in the velocity of money effect and getting capital back to our investors, but also back in our pockets and then into the next opportunity.
And how much of quote your money goes into the deal?
It really just depends on the opportunity. It depends how much that the underlying joint venture is bringing to the table, how much capital we have with our fund. But Colony Hills Capital is bringing additional capital besides our fund investment, anywhere between about, I'd say 5 to 10%, depending on the deal of the equity to the table.
Okay. And is each uh, apartment building its own fund?
No, so I mentioned you can invest in a direct deal, so you could have all of your capital, $100,000 investment into the one deal, or you can
Okay.
invest in our co-GP fund that has anywhere between 3 to 5 properties in it, and then that 100,000 will be allocated evenly.
Very good. Okay. Second trivia question we have is, what is the Ford Mustang named after? Ford Mustang. What did the Ford name it after? It's very, very specific on this. Call 888-912-1190. First caller with the correct answer wins that tanning certificate. Again, it's worth about $100. What is the Ford Mustang named after? All right, stay with us. You are listening to The Best of Investing. Don't touch that dial. We are going to be right back. Welcome back to The Best of Investing. One more time. I'm Edward Brown, your host, along with Matt Spagnolo. Second trivia question. What is the Ford Mustang named after? You know this one, Matt?
I think I do. Is it named after a plane?
Yes, the P-51 fighter plane of World War II.
Right, I thought
Not
so.
bad. All right, so I have every once in a while I like to do a silly joke of the week. So this is a silly joke of the week. So the cashier at Target told me strip down facing me, and by the time I realized she meant my debit card, it was too late. Okay, we have Matt Spagnolo from Colony Hills Capital. And by the way, Matt, why don't you give out your name, we already know your name. Give out your information in case people are listening and they want to know more about Colony Hills Capital.
Yeah, absolutely. Again, I work for Colony Hills Capital. You can reach either myself or my team at our website, colonyhillscapital.com. There's information on there about our fund, but also our direct deals. Our full team information is on there as well. So that's probably going to be the best place to reach out to me. If you want to reach out to me directly, you can find me on LinkedIn as well. I'm always interacting on LinkedIn with either investors, but also partners and everybody in the workplace. So shoot me a message on LinkedIn or on our website.
Very good. Let's go back to this co-GP vehicle. Why is it different? What is it and what's the benefit?
Yeah, absolutely. So we developed the co-GP vehicle and the co-GP funds and direct deal offerings in 2020 during COVID. We wanted to provide a unique vehicle that did a couple things that differentiated Colony Hills Capital from some of our competitors. A lot of new operators and sponsors were jumping into the marketplace when low interest rates were around and deals were flying all over the place. And how were we going to stay top of mind and different from some of the other operators out there? So the co-GP vehicle allows investors to, we call, earn like a GP, but remain passive like a limited partner. And what I mean by that is you have all of the benefits in terms of the passivity that you're looking for as a limited partner, but the sized returns are 20 plus IRRs and 2.5x equity multiples. So you're getting returns similar to how a general partner would earn. And the structure, I won't bore you with some of the logistics of how it works. But if you're interested in that, shoot me a message and we can talk through it. But we provide GP sized returns in the 20 IRRs and 2.5x equity multiples, but you still have that passivity that you're looking for, and you get access to some of that depreciation.
Okay, so now investing through retirement accounts, I assume one can do that, but because the retirement account, like an IRA, doesn't get the benefit of the depreciation, do you guys do some kind of allocation separation on that, or?
No, if you're using the IRA as a tax shelter, it's not really a way to pass through the depreciation.
Sure.
A lot of people use that more to offset some of the gains that they'll have, one, the income, but also the proceeds from sale. But we've got investors who come through retirement accounts, traditional investment accounts. People invest together as businesses. There's a multitude of ways to invest with us.
Gotcha. How much under management are you guys managing right now?
Yeah, good question. I mentioned a little bit earlier, 1.2 billion in total capitalization. We've done over 13,000 units. So we got about 10 or 11 properties. This will be the 12th property that we have under management. So a few 100,000 in AUM currently.
A few 100,000.
Sorry, a few hundred million in AUM.
Oh, gotcha. Okay, because yeah, I mean the capital gets, every time you sell assets and you get more, it kind of gets rotated.
Our average deal size is 50 to about 150 million in size.
Okay, that's how many units is that generally?
Anywhere between 2 to 500. We won't really do anything less than 200 units.
Okay, yeah, I guess economies of scale kind of, interesting. What's the minimum investment?
For our deals, the minimum investment's typically 100,000. If you're interested in our co-GP fund, where your capital is a little bit more diversified over a few properties, that minimum is a little bit lower at 50,000.
Gotcha. You have to be an accredited investor, I presume.
Yep, all accredited investors for all of our deals, but as well as our fund.
Okay. And what is Colony's success? Let's see here if we have time for this. Actually, you know what? We'll ask this next question when we come back, which is going to be, what has Colony's success been and how can you apply it to your investment journey? All right. Our third trivia question: which fruit glows blue under UV light? Which fruit glows blue under UV light? That's a weird question, but okay, that's what it is. Call 888-912-1190. First caller with the correct answer wins that tanning certificate. One more time, I'll ask this question. Which fruit glows blue under UV light? All right, stay with us. You're listening to The Best of Investing. Don't touch that dial. We are going to be right back. Welcome back to The Best of Investing. One more time, I'm Edward Brown, your host, along with Matt Spagnolo. And our third trivia question: which fruit glows blue under UV light? I don't know how anyone even figured this out, but okay.
I've got no idea. I'm just gonna guess. I don't know, banana.
Yes, a ripening.
Oh,
We'll give
God.
you credit because banana is that very good. You're 2 for 3, my friend. That's very good. All right, we teased the audience with what we were going to talk about here. What's Colony's success been, and how can you apply it to your investment journey?
Yeah, we've been pretty successful for over 15 years. Like I said, deals that have gone full cycle, we've achieved an average IRR of 36% on those transactions. So we do a couple of main things, right? And the criteria has been the same. I think how you can apply it to your investing journey is not chasing shiny objects, right? So everybody is diving into different investment opportunities and asset types and asset classes, and Colony has stayed consistent for 15 years, right? We've done value add A minus to B multifamily garden style, and people get to know what we like. The brokers know that, hey, if they've got a really great deal, they can come to us. Colony wants it, and they're going to close. Um, Buying right is always a very common cliche. Making sure that you're buying properties and you're not chasing them. And we have to do a lot of that right now. Is be patient, and we want to do a ton of deals, but we have to make
Yeah.
sure that we're not paying too much for them. So we sit back and we let sellers come to us. We know that a lot of our sellers are either rolling up funds or they're going to need liquidity at some point. So we wait around and we wait for them to come down to us on the acquisition side. But then hiring good people and having everybody really strong in-house, making sure everybody's doing their job specifically. So I think all of those factors coming together has allowed us to be successful. But also a shout out to our investors who consistently come back and are investing in future deals. Without their equity and their partnership, we wouldn't be able to continue to scale and acquire new properties.
How many employees do you guys have?
We're right around 20 or so. We got a couple that fluctuate kind of on a consulting basis in and out, but pretty lean team. And the co-GP model allows us to stay pretty lean.
And how many deals generally do you do a year?
Yeah, that's another good question. We would like to be around 5 to 8. Again, with liquidity and the spread between bid and ask, we've been more like the 2 to 3 recently. We would
Yeah.
like to do 5 to 8 is where we'd like to be at.
Yeah, I mean, it takes a while to do due diligence on apartments, and you have to do all your inspections and look at your rent rolls, and yeah, I mean, I kind of can imagine all the various aspects, and then to get the God, lost my train of thought. Um, when estoppels from the
Yeah.
tenants to make sure that they know what they're paying and all
Yeah.
that fun stuff.
Well, sometimes they take anywhere between 3 to 5, 6 months to acquire just one asset. So that's why we've been trying to do more at scale versus doing 1 or 2 or 5 properties at 20 million in size. Why don't we just do one big deal at 100 million? So
Yeah.
again, for us, we want to continue to do more and more deals at the 50 to 150 million in size. But again, it takes two sides to make a deal, and unfortunately, our deal flow has been strong, but where we're landing on price isn't what sellers want.
All right, so we have a little bit of time. Give us a home run story and a horror story.
With our properties.
Mhm.
I'd say our last exit was probably our home run. We had a 48 IRR in about 2 years and 3 months. We bought it, great deal right after COVID. Went in, executed the business plan right away, and then sometimes when the market's hot and rates are low and people are looking to get into the business, they will take an offer or they'll pay a little bit more than they normally would. So we got a very unique offer on a deal that we weren't even done fully yet, but we had achieved a 2x for our investors in a little over 2 years. So
That'll get the investors to want to put their money back in. I get that.
that was definitely a home run. A horror story, I wouldn't say it's a horror story, but definitely a challenge, I would say, is there was a property we had to buy with variable rate debt on it. And with the jump in interest rates, that obviously affected our debt service a little bit. So luckily enough, our CEO, Glenn Hansen, had the foresight to purchase a rate cap. So we were kind of capped out on how high that interest rate jumped. So that property has a unique story, and we're working through it. But we have the light at the end of the tunnel, and we're gonna work through it. But it definitely wasn't a 2x in 2 years.
That's okay. These things happen. Tell you what, why don't you, before we go to our break again, go ahead and give out your information if people are interested in finding out more information from you.
Yeah, absolutely. I mentioned earlier colonyhillscapital.com. We've got a great new website on there that has our fund as well as our direct deal offerings and our team. Matt Spagnolo on LinkedIn. Feel free to connect with me and message me. I love meeting new people as well as connecting with everybody in their own respective businesses or what they're doing professionally. And if you just want my email, it's matt.spagnolo@colonyhillscapital. Pretty responsive on email as well. So appreciate your time, and look forward to hearing from everybody.
Very good. And again, for those people who are interested in checking out Pacific Private Money, they don't buy real estate; they're lenders, and so they're on the lending side, just like the bank. And some of their funds pay as low as 7%, and this one that I mentioned earlier pays as high as 10%. Very conservative. We don't own real estate, don't get the depreciation, but it's just like it's very similar to having money in the bank. Obviously, it's not FDIC insured, but it is backed by the real estate, the mortgages. So check them out at pacificprivatemoney.com. Stay with us. The Best of Investing will be right back with some closing comments. Don't touch that dial. And we'll have our famous thoughts for the day. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with my special guest, Matt Spagnolo of Colony Hills. And no trivia question, but Matt, you guys are almost finished with a raise on a certain deal, right?
Yeah, it's an awesome opportunity and just outside of Hartford, Connecticut. A loan assumption opportunity with a couple other unique pieces to the opportunity, but the numbers are pretty exciting for a value add deal. I mentioned the cash on cash earlier, just shy of 10% over that 5-year period, and about a 2.5x equity multiple for our investors. We're pretty excited.
Okay. How many units is that deal?
It's 204 units.
Okay. Yeah, it's interesting how apartments are really. I wrote an article on this years ago where, let's say Home Depot carpet is going to cost almost the same whether you're in California, Timbuktu, or Connecticut. So depending on how big the unit is and how much you're getting per rent, is very challenging potentially. I mean, you have to have a sharp pencil sometimes to make sure that you get enough of a deposit, and then however you're going to improve the unit to get certain rent.
Yeah, absolutely. For us, our main strategy really, as I mentioned, finding these mismanaged deals where there's significant loss to lease, or the neighboring property is $300 or $500 higher in rent, and our property is significantly below, right? So we're finding those deals that haven't captured that margin, and over the first few years, we're going to come in and through renovations, improving the property, we're going to achieve that just mark to market, and any market rent growth over top of that is really just going to be gravy for us.
Yeah, because a lot of times you'll get an owner who the rents are too low, where they don't have enough excess cash to do those improvements to raise the rents. So they're sort of caught in a catch-22. If you guys
Absolutely.
money, yeah,
Absolutely. That's a common theme with the sellers for our deals, is they need liquidity for their fund, or they need liquidity to fund another project. This one, the seller actually realizes how much is left in the deal, that they're leaving about $10 million of equity with us in the property. So they're getting the sale and liquidity that they need, but they're keeping that capital in the deal at pretty accretive terms to Colony and our investors. So again, there's a couple of unique pieces to this one that we're super excited about.
Yeah, I like when you can get creative. Either with the financing or with let's say in this case with the seller.
Yeah,
Very, very,
creativity is the only way that deals are getting done right now. So the loan assumption, the seller, some of the partners that are coming in, pulling those different pieces and strings to make the deal work is what takes to do deals right now. And again, having a great team and a great operator are the reasons that those deals get done.
Yeah, and the size that you're working in, you're really not probably going to get too many mom and pop owners. There are going to be funds that already own it, the units, right? For the most part.
Not a ton of mom and pop. I'd say sometimes if we get it to the 150 million in size, those sellers are more institutional. But if we're below 70, 80 million in size, then there's some of these smaller shops that are similar to us, or more boutique groups. But then when we sell the property, we'll look to exit to an institution.
Right. All right. Matt Spagnolo from Colony Hills. Thank you so much for joining me. Here's our thoughts for the day. So I just bought my coworker a Get Better Soon card. He's not sick. I just think he could do better. And I was drinking whiskey, and the bartender screamed, "Does anybody know CPR?" And I yelled, "Well, I know the entire alphabet. We all laughed and laughed. Well, except for this one guy. All right, audience, tuning a little dark humor on that one there. Audience, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.